So Shane, so I just sent out an email last week with like 4 different types of mortgages, and we'll get into those. But like, when you have a buyer that comes across and it's like, I really want to buy a house, but I'm not sure, if we would have bought it a year ago, our payment would have been a lot less, but they may have overpaid for the house. So now they don't have to, they can get a deal, but interest rates are higher. So what are some things that they can do, different types of mortgages, to make that work?
So adjustable rate isn't what it used to be, in a good way. Current is better than old.
What did it used to be?
Adjustable rate meant that it had a balloon payment. So all institutions go to a bigger bank, a bigger institution, and borrow money. Okay. That institution, when they know that they're doing an adjustable rate, has a balloon payment where it's whenever we say it's due, it's due.
So like, I think we had before like a 5-year ARM, right? So what does that mean? So if you get the loan today, does that mean you have a lower interest rate for 5 years?
Correct. So the current way that it's set up, there aren't balloon payments allowed on any conventional Fannie Mae, Freddie Mac, even FHA loans. There's no balloon payments allowed. So what that means is that there's usually 2 numbers. Someone will tell you, like, we have a 5/6 ARM, 5/6, right? Okay. 5 is going to be how long the rate is locked. Okay. The 6 means, so after 5 years, beginning of year 6, we will look at what the current economic climate is compared to the current economic climate of the original lock. Okay. If this climate has a higher interest rate, your rate will go up. Okay. If it's lower or the same, it'll stay the same. Then it gets reevaluated every 6 months. That's where the 6 comes into play. Okay. 5/6.
So that's 5/6.
And the difference between old school and new school is, first adjustment, the most it can go up is capped at 2%.
Is that now or the way it was?
Nope, now. Okay. So like at the end of 5 years, at the beginning of year 6, let's say the economy hasn't changed and rates went up, the most that it can adjust, let's say you locked in at a 7%. Well, it would be an adjustable rate, so let's say it's 6%. Okay. After year 5, the beginning of year 6, the most it could go up is 8%.
Okay, so 2%. How low is that 5-year that you can lock in? How far are you getting those down? Does it depend on the client?
Yeah, so it depends. It depends on all the variables that normally go into it. Your loan to value, debt to income ratio, credit score. Okay. I can tell you that there are institutions that do have a ton of options to buy down rate. Ent is a little bit different. We keep our rates really close to the margin. We only have 3 options to buy down. So if your rate's at 6 on an adjustable rate, you can buy it down to 5.875, 5.75, 5.625, and that's about all that we have available.
So let's put some numbers to that. So say you have a $500,000 house, because we're finding some houses, like the average house price has gone down a little bit. $500,000 house, you've got a pretty decent credit score, like 700 or so. You're in one of the top tiers of credit lending, and you don't have too much debt to income ratio, the DTI. If you got that down, even like an 8th, 5.875 from the 6%, what does that cost you up front?
It's always going to depend on the current market as well. So if rates are going up, it would cost you more. Usually our lowest rate option is 1.125% of the loan amount. Well, so if it's a 7% on a 30-year fix, you'd only have 3/8 of an option. So it would be 7% on a 30-year fixed. You go to 6.875, 6.75, 6.625. Okay. So you would be able to buy that down to 6.625. Okay. That is the way that we make our business model. Is we are going to offer the lowest rate available at 0 points and don't have a ton of runway to buy that down. Where other institutions will have a higher rate and they have a ton more runway to buy that down. That's the way that we do business, because we want to have the lowest fees available, along with the most competitive rate with no cost.